Hi, I'm Tim Kelley from Montgomery Investment Management and welcome to this week's Video Insight. Today I want to talk about some developments we've noticed in equity markets recently that may have significant implications for investors through 2013. If we look at how the Australian market has performed over the last 12 months, the ASX 200 index has gained about 13%. If you add dividends, the total return is about 18%, which is a good return by historical standards. However, if you dig a little bit deeper, that return wasn't evenly spread through the year. The first half of 2012 was more or less flat, so those gains have all come in the last 6 months of last year. What that means is that the rate of return on the market in the last 6 months has been very, very strong indeed, and at the same time, volatility has been low, so the equity market has been a pretty attractive proposition in terms of risk and return. If you dig a little bit deeper still, those gains haven't been evenly spread. The gains in particular have been focused at the top end of the market, larger companies, particularly those with a high dividend payment. And if you look at things like Telstra, the major banks, the property trust sector, the gains are north of 25%. On the other hand, if you look at the ASX Small Ordinaries Index, which excludes the 100 largest listed companies on the Australian market, the gains have only been around 5%, well short of what's been achieved by the larger end of the market. Another thing that we've noticed recently has been the flow of money into managed funds. If what we're seeing is indicative of what's happening in the broader market, then a lot of money that has been parked in cash is now finding its way back into equities. It seems as though a lot of investors are becoming frustrated with the low returns earned on cash, and when term deposits mature, rather than rolling at a reduced interest rate, they're choosing to find something else to do with that money, and often that means putting the money into the market. And that ties in pretty well with what we're seeing in the markets. When people start to feel comfortable taking additional risk and moving money from cash into equities, it's natural that they should look first to those investments that they perceive to be lower risk. And often that means companies that are large, well-known, and have a high dividend payment. Over time, if the equity markets continue to deliver good returns, we'd expect to see that performance differential between the large end of the market and the small end of the market to gradually close up. The challenge, of course, is in knowing whether and for how long the current trends in the market may continue. Our sense is that there's still a lot of cash on the sidelines, and so it's possible that we're at the start of an extended run of good returns. Of course, having said that, equity markets are very complex, and trying to forecast short-term returns doesn't form part of our investment process, because at the end of the day, we're not convinced that we can do it reliably. For us, the focus is where we can find the best value, and with the prices of large cap companies having risen significantly faster than their earnings in recent times, value is becoming concentrated amongst the smaller and less well-known names, and so that's where we're focusing our attention at the moment. If the recent trends that we've seen in favour of big cap stocks continue, that may mean that we underperform the market for a period of time, but we're comfortable with that. We know that in the long run, focusing on value will deliver a good result, and we'd rather be confident of delivering a good result in the long run rather than hopeful of a good result in the short run. In summary then, there are a couple of points to take away. Firstly, markets have performed very well recently, and while it's enormously difficult to forecast short-term direction, there are some reasons to think that that may continue for some period of time yet. Secondly, in thinking about how you position yourself in the context of the current market, we'd encourage you to remain focused on underlying businesses and their earnings prospects over the long term, rather than getting too caught up in what the market is doing, because in the long run, it's those earnings that will drive your investment success. That's it for this week. In the weeks ahead, Roger will be back with more video insights, and in the meantime, you can follow him on Facebook and Twitter. Until then, thanks for watching.